Hello and welcome to our channel, where we talk about personal finance, investing, and wealth building strategies. Today we're going to discuss the banking system and why assets are better than cash money, and why you should consider investing your money in assets to grow your wealth over time. The first thing you should know is what is fractional reserve systems and why you have to invest your money. The cash is something not real and it's losing value over time, but the assets are going to carry you in the inflation times like now. The fractional reserve system is a banking system in which banks are only required to hold a fraction of the deposits they receive from customers as reserves. The remainder of the deposits can be loaned out to other customers, thus creating new money in the economy. For example, if a bank has $1,000 in deposits and is required to hold a reserve ratio of 10%, it must hold $100 in reserves and can loan out the remaining $900. If the borrower of that $900 then deposits it in another bank, that bank can also loan out a portion of the deposit, creating even more money in the economy. This process of creating new money through loans is called credit creation and is a key feature of the fractional reserve system. However, it also means that banks must manage their reserves carefully to ensure that they have enough cash on hand to meet the demands of customers who may wish to withdraw their deposits. The fractional reserve system is widely used in modern banking and is designed to facilitate lending and economic growth. However, it also comes with certain risks, such as the potential for bank runs if customers become concerned about the safety of their deposits, and the possibility of creating excessive amounts of credit that can lead to inflation or asset bubbles, like now. You can use banking to get assets through loans. For example, if you take out a mortgage to buy a house, the house becomes an asset but only if you rent it out. Something is an asset only if it generates income. Similarly, if you take out a loan to start a business, the business can become a valuable asset, and so on. We can see that the printing of money is out of control. The banks lent far more than they had, and because of that and the pandemic, the Fed printed trillions of dollars, which created enormous levels of inflation. Inflation is the rate at which the general level of prices for goods and services in an economy is rising. Put simply, it means that over time, the same amount of money will buy less than it did before. Inflation can be caused by a number of factors, such as an increase in the money supply, a decrease in the supply of goods and services, or an increase in demand for goods and services. When there is more money available in the economy than there are goods and services to buy, prices tend to rise as people compete to buy those goods and services. Inflation is typically measured by the Consumer Price Index, CPI, which tracks the prices of a basket of goods and services over time. If the CPI increases, it means that inflation is occurring, and the value of money is decreasing. While some level of inflation is normal in a healthy economy, high levels of inflation can be harmful. It can lead to a decrease in the purchasing power of money, which can hurt people on fixed incomes, such as retirees. High inflation can also make it difficult for businesses to plan for the future, as they may not be able to accurately predict the cost of goods and services. While cash money is easily accessible and can be used to make purchases, it does not typically generate income on its own. In fact, holding cash for an extended period of time can actually be detrimental to one's wealth, as inflation can reduce the purchasing power of the cash over time. On the other hand, assets such as stocks, real estate, commodities, or even certain types of bonds can provide the potential for growth and income over time. For example, a stock in a successful company may appreciate in value over time, providing a return on investment when sold. Real estate can also appreciate in value over time, while also providing rental income if it is rented out to tenants. Additionally, some assets can provide a hedge against inflation. For example, if inflation causes the prices of goods and services to rise, the value of assets such as real estate or commodities may also increase, providing a hedge against the loss of purchasing power that can come with holding cash. So, to sum it up, assets are way better than cash money because they provide the potential for growth and income over time, can provide a hedge against inflation, and provide diversification to manage risk in your investment portfolio. Investing in assets is a way better strategy than holding cash over the long term and will make you wealthy. Thanks for watching, and don't forget to like and subscribe for more financial tips and strategies.